Hello, income harvesters. Welcome back to the Harvesting Income. Make and grow your income. In today's video, I'm going to talk about an interesting topic, which is about choosing a covered call fund and what to look for. In this, I'm going to focus on this aspect of high income, whether it is a rip-off or a trade-off. So, to answer this question, we have to understand the mechanics of the covered call strategy or how it is executed, and what is the coverage that the fund has, and what type of calls they write, etc. So, with that, we will quickly jump into this video and let me start with a small concept so you will understand exactly what I am going to reveal as we go ahead. The first part to understand is how much of the portfolio is covered, like whether it is the entire 100% of the portfolio covered or higher amount of the portfolio that is covered. Okay, let's start with the first one. So, a portfolio which has high coverage, like higher coverage, like 70%, 80%, they have a scope for higher income, whereas the fund will give you lower appreciation. Keep this in mind. This is like a trade-off. Like so, when the fund is giving higher coverage, they're writing more calls, they are generating more income, but they are sacrificing more of the appreciation because the covered calls hit a ceiling or a what do you call that? An upside ceiling on the capital appreciation. So that's why they get capped at that level. Okay. On the other hand, you on the other there's an extreme example I will give you here. Full coverage. When a fund has full coverage, they have again extreme very high income, but there's no appreciation at all. Okay, so that's what happens if the fund is fully covered. But what if the fund has a lower coverage? It's going to be exactly the opposite of the first scenario I mentioned. The fund has a lower coverage, then they have lower income, but higher appreciation. So that's something to keep in mind. So basically, what we are looking for is low to moderate coverage. So I've given you the worst and the okay kind of worst scenarios basically, or extremely high coverage scenarios. But what we are looking for is low to moderate coverage. I will explain, the different scenarios in the next page, but this is something to keep in mind because this is what we are going to focus. Uh, this is pretty clear in terms of the coverage. The other part is the moneyness or the how much at the money, how much out of the money the call is. So before I go to that, let me explain the concept. Let's say we have S&P 500 at 7,500. If a covered call fund is going to write a call above 7,500, like say 7,550 or 7,600, that is called an out the money call. That is what we expect usually because we want the fund to write calls at higher levels and capture the appreciation. But there are some funds, keep this in mind, who write calls almost around the current market level. Like current market level is 7,500. The fund writes a covered call around the 7,500 level. Okay. So what is the difference here? So when they write at the money call around the same market level, there is no appreciation. There is a high income, right? So that's what is happening in the first scenario. At the money, high income, no appreciation. Whereas if the fund writes out the money like 7,600, so they are capturing that appreciation from 7,500 to 7,600, but the income is going to be low because the option buyer is going to pay lesser amount of premium at higher levels. So basically, what's happening is the fund is actually taking a trade-off by taking lower income in exchange for a higher amount of appreciation. Could be appreciation or capital gain or you know growth. You can call it with different names. It's the same thing. Okay, what do we really need to look for a mix that suits your goals? Like so, in this case, I'm not giving a specific answer or a guidance. It will obviously depend on your goals, your situation. So you can consult with your financial advisor. Uh, what do I do? Like I pick at the money call, ETF for regular income or regular income flow or distributions. And I would pick an out the money for a long-term appreciation plus income. There are funds which do out the money calls. For example, DIVO, plus there are other funds which do out the money calls. HHIS does a bit of that. And There are examples. ESPX fund also does that, Evolve fund. Now, we will come to that examples, but now I'm going to show you the different scenarios. This is just the starting point. So basically, you're looking for low and moderate coverage, and you're looking for a mix of at the money calls, at the money call writing funds, and out the money call writing funds. So if you are more oriented towards appreciation and conservative, you will like you will go towards out the money funds. Whereas if you are looking for regular income, you may go for the ATM funds. But going either extreme is not generally recommended. You may use the mix of two. So, okay, with that, we go to the next area, which is very interesting, especially if you are a mathematical nerd or you like looking at different scenarios. Okay, to just simplify this, I have taken at the money call scenarios. Okay, so there are different one, two, three, four scenarios. All are at the money call scenarios. However, one thing to keep in mind is the coverage level varies. I'm starting with 100% on the top and then reducing it 70%, 50%, 30%. Again, this is just an example to give you a kind of a concept or a framework. The exact amount of coverage or level would completely vary fund to fund. Even for some funds which they say that they have a certain coverage level, it can vary according to their portfolio and market conditions. Okay, with that, what happens if a fund has a 100%, you know, coverage and they write at the money calls, the first row? So they would have a very high income potential, but they have no capital appreciation. Now, moving to the second scenario, you have 70% coverage level, then you have at the money calls. Again, you have very high or high income potential. In this case, you have a little bit of scope for capital appreciation. So that's the advantage of lowering the coverage. Okay, let me give you an example of the 100% scenario, the first one. There are funds from Global X, XYLD, QYLD. They have um, calls which are written at the money, and they write calls on the entire portfolio, entire S&P or entire Nasdaq. So XYLD does it on the S&P 500. QYLD writes calls on the Nasdaq. So that's how the fund works. And if you look at further down now, that's the example for 100%. 70%, I don't have an example. Probably you will find some funds which do that type of strategy. If you know any names, please drop them in the comment section below. Uh, Now we come to the very interesting sweet spot, which is the 50% level, which a lot of funds use. They write at the money calls. They write on the entire. They write on half the portfolio, and they generate moderate amount of income, and medium appreciation. So it's basically like you're not going to the extreme full coverage. You're not going to the extreme low coverage. So you're getting decent income and you're getting a decent amount of capital appreciation, and overall you're getting a decent amount of total returns, and you're able to maintain the consistent performance over a period of time. I mean, it sounds a little extreme, but it's basically like you're balancing, not going for the high income, but moderate, not going for a low or high capital position, again, moderate, like the middle of the pack. A lot of funds from Hamilton, like example is given below. Hamilton yield maximizer ETFs, SMAX, QMAX, CMAX, they use this strategy. And once again, XYLG, QYLG from Global X, they also use this strategy where they do 50% coverage. And the good news is that XYLG and QYLG perform better than, you know, XYLD and QYLD because they are writing only calls on the 50% of the index. So the remaining 50% can appreciate fully. They have the full market exposure. So, so those are the pros and cons. Like lower the coverage, your income may appear to be low, but you're getting the higher capital appreciation potential, and you're holding those stocks for a longer period of time. So you are getting that stock or market exposure. So the last one is extremely low, like extremely low, 30% the money, low income and high capital appreciation. So the last scenario is probably true in case of some funds like DIVO in the US market. So I've done one video on the DIVO in the past. You can take a look. Uh, I don't think of Any other example? There are some funds which do that. I'm not able to get that example in front of you right now. But yeah, I wanted to give you the typical examples that you come across, very common on an everyday basis. So in Canada, most of the funds you are mostly around this 50%, or probably some of them are around 30%. So this is how, the ATM call scenarios work. Uh, if there is anything I missed, or if you have any other suggestions, any comments, or any technical points that I might have missed, let me know in the comment section below. I'll try to cover that in the next video, or probably in the future videos. Now we are going to another interesting area, because we are talking about out of money call right scenarios. This is slightly different because when we start with the 100% coverage, obviously the income potential is very high, or high. But the thing is, the capital appreciation is not zero, or it's not. We are not seeing no capital appreciation, but we are seeing a low amount of capital appreciation. It's pretty low, but it's not like non-existent. So that means even if you do 100% right, because you're doing out of the money, you're able to capture that difference between current market level and the strike price. So you don't have a cap at the current level, you have a cap at a higher level. And when you go down to 70%, obviously you have a higher income and medium capital appreciation. Now, for the 100% example, there is iShares buy right funds, IVVW, which writes calls on the S&P 500 index, and IWMW, which writes calls on the Russell 2000 index. So those two are very popular. Good news is IVVW writes calls which are 2% out of the money, and IWMW writes calls which are about roughly 3% out of the money. So which means that they are giving that headroom for capital appreciation. That's a good news. So we discussed the first two. Now let's move to the sweet spot, which is the 50%. Again, the sweet spot is what I'm saying is a sweet spot, but this could vary depending on the fund, depending on the investor, depending on what you're looking for. Sweet spot, basically, I'm calling it because it's the middle of the pack, but the exact sweet spot may be slightly higher or lower. 50% coverage level, you get low amount of income, but you have high capital appreciation. Why low income? Because you're writing out of the money calls. You're not writing at the current market level, and you are writing out away from the current market level, and you're writing only on half of the portfolio. So the premium income is little less, but you have the scope for capital appreciation. So funds like HHIS, HHIH, all these do this kind of strategy. Um, yeah, some of you might argue that these funds are giving very good, returns in terms of the distributions. For example, HHIS gives you like 20% or more, like in distribution yield. They're able to do that because uh, they're able to use leverage to increase the income. I'm saying low income here on the table, but that low they can convert it into medium income or maybe slightly higher. And capital appreciation can go from high to very high, like because they are going to add another layer of leverage, like 25% leverage. So harvest funds like HHIS, HHIH do that. Some of the funds like IDVO, QDVO from the Amplify ETFs, they also might do this. And I think even the Evolve ETFs, some of them are, doing roughly around 50%. But again, these funds are not exactly doing the 50% coverage. Like they can vary the coverage between, 30 to 50%, or like 40 to 60%, like depending on the fund manager's strategy or the fund house's own guidelines or strategy that they have in place. Okay, let's come to the last part, which is the low coverage, like 30% out of money. You have very low income potential, but you have very high capital appreciation. Some of the funds like DIVO, they do this strategy. HDIF is also an example. So HDIF is very, you know, slow in terms of the dividend distribution or the distribution yield. Not Still, it is giving you a decent yield, but not that attractive. And similarly, appreciation wise, it's not that great when the market is very slow. But in the current market, HDIF is picking up pretty fast. So again, what would work well, or what would define the success depends on the market conditions too, not just the scenarios or the strategy. But is the strategy allowing you to capture the capital appreciation, allowing you to capture income? That's the question you need to ask. So, is the strategy allowing you to capture adequate amount of income and adequate amount of capital appreciation? If the answer is yes, uh, then you should choose that fund because it meets your income goals, it meets your desired level of income or level of capital appreciation. And again, some funds would do well on the appreciation part, some funds would do well on the income part. So having a mix of both is always good because you want to play and win in different market scenarios. You don't want to be that one trick pony, right? So you want to win in different scenarios. So you will use slightly two or three different funds for two or three different market scenarios. So if the market scenario wants to, it's going to give you that application potential that you want for your portfolio, then choose the fund according to that. Or if you want more income or a mix of both, choose according to that. So all in all, these scenarios are helpful in terms of avoiding the extremes. You want to avoid some extremes or very high yield funds and choose something that gives you a middle of the pack approach, and that will help you build your portfolio and help it grow and generate strong total returns, sustainable total returns over a long period of time. Yeah, I think it was a very technical and lengthy video. I hope you like this. And if you have any questions, any more information you need, or any clarifications, please feel free to drop them down below. And I hope you like this video and have a great day. Happy investing.